majority of triple nets that we're doing, we really deal in the QSR space, the quick serve restaurants, car washes, paint stores. Like any business, location is key. You really need, obviously, clientele. You need to drive traffic. You need sales, and that's what makes a location strong.
Welcome back to Keeping It Real Estate. This is episode 84 with Kyle Schlangen. And we're really excited to have Kyle back on the podcast with us today. He was actually on with us about 6 months ago on episode 36. And today with Kyle, we're going to be diving into triple net lease investing. Kyle's been specializing in triple net lease investing for 8 years, and he's acquired approximately 20 triple net lease properties. And he's really had some tremendous results. So we're going to go ahead and get into why triple net lease investments are so beneficial, as well as what to look out for when considering a triple net lease investment. With that, Kyle, welcome back to the show.
Great. Thanks for having me, Mike. Great to be here.
Most definitely. Well, this is going to be a great one. And, I just wanted you to start off by giving us a brief background on yourself and how you got into multifamily and commercial real estate, and then also specifically the triple net lease space and how you found that space.
Certainly. Started during college in 2004 with just a single family, renting it out to friends. Sold that, started an auto repair business in 2006. And we actually bought a 48,000 square foot facility, of which our tire shop was a part of, and leased out 7 other spaces within there to other tenants. Eventually sold that in 2020. And I've realized quickly in 2015, we needed to find some other avenues for investment. So I started really delving into the triple net space and really got sucked into it. Absolutely love a lot of the tenants and the benefits that it brings tax-wise as well as investment-wise. So we've been rocking that pretty hardcore for the last 8 years, and hopefully continue to do it for the next 30 to 40.
Awesome. I love the backstory. So bought a tire business, and if I remember correctly, you purchased the actual commercial property that was attached to that business as well, correct?
Correct. We actually bought an old warehouse. Like I said, it was like 48,000 square feet. And our tire shop was 7,500 square feet of it. But it was just a great location, and we got a really good buy on it. So we found a way to reface the building, bring in a handful of tenants. We brought in a dentist, an Anytime Fitness, a brewery, nail salon, hair care place. So really got to work with a lot of eclectic tenants, and it really was a good training into learning how to deal with tenants, triple net leases, and what tenants we also don't want to deal with.
Got it. I love that. And we'll dive into that further in just a bit here. But before we get any further, if you want to explain exactly what triple net and triple net leases mean, that'd be fantastic.
Sure. Triple net is just, it's an acronym, net. So what it means is if you own a property, the tenant is on the hook for directly paying all of the property taxes, all of the insurance, as well as keeping up all of the maintenance on the building. So again, it's really just a hands-off investment where all you're doing is collecting rent once you close on the property.
Got it. And then a double net lease, if you want to explain the difference in between that and triple, that'd be great.
Absolutely. And there's all kinds of different leases. And there's modified, there's ground, there's double net. We do some double nets. And what that essentially means is we are on the hook for some of the roof and the structure stuff. The tenant still pays all the taxes, still pays all the insurance. But the big thing about a double net lease is it's very important that we go and take a look at the building ourselves just to make sure there aren't any major maintenance issues that a tenant is going to have in the foreseeable future during our ownership.
Got it. And I'd love to hear a little bit more about what you love about the triple net lease space. So you obviously have done multifamily. We've done a couple deals together as well. Yep. You've done commercial, you've owned your own business, you've owned triple net lease properties, you've owned double net lease properties. So you've done a lot in the real estate investing space. Why triple net, and what do you like more about triple net compared to other spaces?
I love all the spaces when they create yield. Multifamily, I really enjoy as well. Multifamily is certainly more hands-on. Double net, same thing, a little bit more hands-on, ensuring that a building is in good shape. The triple net, what I really love is once you do your homework on the front end, if you've got a relationship with a tenant or you really like a location, once you've got that property purchased, it is really a minimal time consumption. Once you get through closing on a property, if you've got, whether it be 2, 5, 10, 15, 20 years, whatever it may be on your lease, it is literally mailbox money. You're just getting a check cut to you every single month. All you have to do is make sure it's in your bank account. There are no bills for you to pay. It is the most hands-off investment I've been a part of. Mm-hmm.
And that makes sense. Multifamily, you have to asset manage very, very closely for a project to be successful. And there's a lot that goes into it. You obviously have, potentially hundreds of different tenants. You have evictions going into place. You have repairs and maintenance. You have taxes. You have insurance, which is great if you have a great asset management team and a great property management team. But if you're looking to get into an investment where you're looking for that mailbox money, triple net does seem like a great option. And I loved how you mentioned, the tenant, they're responsible for taxes, insurance, and maintenance. And I think in some states, taxes and insurance have been a big issue over the last few years. So if you don't have to worry about those huge increases in costs, that can be really beneficial, correct?
Absolutely. We've noticed that in some of our multifamily properties we've done together. I mean, even if there's nothing wrong with your property, the insurance industry in general has gotten really expensive the last couple of years, and it can really cut into your returns. With a triple net, there's literally nothing to worry about. And if there's something that you want to see done maintenance wise on your building, you really just need to reach out to the tenant, and it's their responsibility to take care of any increases in property taxes, any increases in insurance. I love that they're on the hook for it. They need to work it into their numbers. And as long as you're doing your due diligence on the front end and making sure it's a solid location, you're not going to run into issues.
So let's talk about that a little bit more. Location. In my mind, location is key, especially for triple net, and not even that, industrial, office, multifamily. But why is it so important in regards to a triple net lease deal?
Well, the majority of triple nets that we're doing, we really deal in the QSR space, the quick serve restaurants, car washes, paint stores. Like any business, location is key. You really need, obviously, clientele. You need to drive traffic. You need sales, and that's what makes a location strong. And furthermore into that, obviously, we'd like to do work in business-friendly states where businesses are not getting hammered by taxes and insurance and ridiculous overhead costs and employee costs. So we really like to work, throughout the Sun Belt in tax-free states. It's just obviously the more business friendly it is for them, the better it is for the investor as well.
Got it. And the better that your tenant does, the less likely that they're going to go, into default or have to move stores, correct?
100%.
Got it. And I loved how you said, towards the beginning of the show, as long as you do your due diligence up front, there should be very little that you have to worry about through the ownership or the hold period. Let's talk a little bit about that. Obviously, you're auditing their financials. You're taking a look into the financial stability of the tenants. What does that look like, and how do you go about doing your due diligence on a tenant?
That's a good question. Really every lease is written differently. Some tenants will allow you to see monthly, quarterly, annual financials. Some are not required to report it. So it's really important that you've got a relationship with that tenant. And the tenants that we continue to work with are ones that we've built relationships with. So I can send an email, I can give a phone call and say, hey, what are your sales looking like at this location? Kind of where are your margins? They'll send me typically updated financials, so I can get a really good idea as to how strong that location is. I can see what the rent to sales is. And usually when a tenant's profitable at a location, it's very, very rare that they're going to leave.
Got it. That makes sense. And if they do leave, as long as you have a great location, I would assume you can go out to market and hopefully rent it out fairly quickly. Is that something you pay close attention to as well? Very
close attention to it. As I mentioned in our other podcast, usually when I'm looking at a location, if I have a certain tenant in there and I think things could be a little wish-washy for them based on their financials or their company strength, I've usually got another tenant or two in our back pocket that I know would backfill that location at some point. So we're, again, during our due diligence, we are really paying close attention to ensure that we're not going to be stuck with a building that's not leasable.
Got it. That makes sense. And I'm sure you're paying attention to how unique the building is as well. If it's very unique and it's not going to fit any other tenants' requirements or requests, that might be something that throws a red flag up for you and that you stay away from, correct?
You're absolutely right. And coming back to the point of location, a lot of what we're paying for is the land. The building is obviously necessary to who's ever doing the business there, but we try to buy right in the fact that even if that tenant is leaving, we'd have to scrape the building, we would still be able to come out on the investment over the long haul.
Got it. Fantastic backup plan. Obviously there's a big difference in between, one-off tenants, kind of like you started with, when you bought your tire shop and you were, leasing to different smaller tenants, franchisee tenants, corporate backed tenants, tenants that have multiple stores where it's back in the lease. Can you explain kind of the differences in between different types of tenants and what you look for when you jump into a triple net lease deal?
Absolutely. So as you mentioned, there are one-off tenants that you'll see a lot of times. It may be medical facilities, dentists, some hair care places, stuff like that. I typically try to avoid most of that stuff unless if it's a medical something and their financials are extremely strong, we may consider it. I haven't delved into the space a whole lot. I really like safety. So I'm looking at franchisees that are typically 100 units or larger. And that means that building that we own is backed by the franchisee on a personal guarantee as well as a corporate guarantee that's backed by all 100 of their locations. Obviously my favorite and most people's favorite is going to be a corporately backed lease. So that's with Arby's, for example, is backing it with 3,600 of their locations, or Sherwin-Williams is backing that lease with 5,000 locations and a massive balance sheet. And that's about as safe as you're absolutely going to find.
Got it. I love it. What a great way to mitigate risk.
Absolutely. That's always the goal.
That's exactly right. So jumping into the actual lease terms, I'm sure each lease is a little bit different, but what are the general terms in a typical lease in this space?
It really varies. Typically, a lot of brand new leases that come out will be anywhere between 10 and 20 years. Typically, obviously, the longer the term on it, a lot of times the lesser the cap rate. So I really like to find kind of a happy medium in between there. As you and I spoke about earlier, we're looking at some blended and extend stuff as well on shorter term leases to find a little more yield. But if you're really looking for just a solid tenant that's just going to pay you cash on cash every month, you can typically find anywhere between 10 and 20 years to start.
Got it. And when you say blend and extend, if you can explain that a little bit more in depth, that'd be great.
Sure. So again, being in this space for as long as we have been, we're starting to learn a lot of the intricacies on how a lot of other larger investors have done it. So about the last 3 years, I've really been focusing on what we call blend and extend. So I'll buy something with only 1, 2, 3 years remaining on the lease. And I've got a good enough relationship typically with that tenant where I can go to the tenant and say, what do your sales look like here? How can we work together to extend your lease? And whether that be, I'm making them a payment to do so, or I'm putting something into the building for them to make it attractive for them to extend that lease from 2 or 3 years up to 10 or 15 years. And the difference in cap rate can be pretty significant where usually we can make up that whatever we have to do for that tenant, we can make that up in multiples.
Got it. So it sounds like blend and extend. That's a great way to add potentially a significant amount of value, almost, similar to multifamily. Whereas if you have, 20 years left on the lease or 15 years left on the lease and you just plan on riding it out, that's really going to be a cash flow play, correct?
100%. Yeah. And it's a great cash flow play as well as a depreciation play. And that's what a lot of investors who are coming into this space are really looking for is cash flow and depreciation. And, as the multifamily sector is excellent for it as well. But with where interest rates are right now, the cash flow play can be a little bit more difficult, and the triple net's probably a little more boring, but you're going to get a check every single month, regardless of what happens. And There may not be quite as much upside as multifamily, but if you're going to find the right property, my goal is to find that upside.
Got it. I love it. Yeah, no, that totally makes sense. And as far as cash flow goes, I know in the multifamily space, we're typically targeting around 5%. Is it pretty similar in the triple net lease space, or what are you seeing these days, Kyle?
It can be. Again, it depends on the tenant you're working with and the safety on it. I mean, I would say target is between 4.5% and 6.5%, just depending on, again, tenant, location, kind of business, but 4.5 to 6.5 is pretty standard.
Got it. That makes sense. Now, rewinding back, if a tenant does leave the property, which I don't think that's ever happened to you, is that correct?
Knock on wood, we have not had it happen to us yet, but we are prepared if it were to happen.
Got it. But I mean, that's an impressive track record. You've been doing it for 8 years. You have 20 plus properties. It hasn't happened, and that can probably be attributed to how much due diligence you do up front. But if a tenant does leave the property, you have a great location. You've done your due diligence on that. You have a couple potential tenants, to backfill the property. But how do you typically go about re-tenanting it? Do you go to a broker? Do you reach out to your own contacts? How do you do that?
It'd probably be a combination of both. We've got a lot of our own contacts, and as I mentioned during our due diligence, I'm usually going to those other tenants and saying, would this be a fit for you? How could we make this work? And usually, again, I'll have a say, yes, if they're doing this kind of traffic, these kind of sales, yes, this location would make sense. So usually I'll go with my own contacts. If not, I've got a network of probably 20 brokers throughout the country that we work with who would, and as well as developers who would be very willing typically to find a tenant who would backfill these spaces, because that's how they make their living as well.
Got it. Makes sense. And let's talk a little bit about, failures in the triple net lease space. It sounds like you've had a great track record, great experience, but any failures or hiccups during operations that you've seen in the triple net lease space? And also on top of that, anything that you've seen other investors do incorrectly or something they could have done better?
During COVID, there were certainly some operators who had some issues, and there were some tenants who were asking for some rent deferment for 3-6 months, something like that. I haven't seen anything like that recently. I have obviously heard of failures. I know Ruby Tuesdays had a bankruptcy a couple of years ago. There's a couple of Burger King brands right now or a couple of their larger franchisees who have filed for bankruptcy, and they've left some of those locations. So it can certainly happen, but a lot of those locations that I see that are struggling or people probably lost pretty heavily are in extremely small markets, locations I want to personally look at. So again, that's the way to really mitigate that risk, is to buy in dynamite locations, high traffic locations. And I really think that mitigates everything. And again, I don't take a lot of risk in it. I'm really boring about the way we do our stuff. And that could probably make larger returns if we were willing to take some of those risks. I'm just not. I'm more about mitigating risk and just moving forward with positive cash flow.
I like that investment avenue that you take. Definitely resonates with our outlook as well. So one other quick question here. Tax advantages. So pretty good bonus depreciation and depreciation year one of ownership on triple net lease deals. Are you able to explain, typically what you're seeing for a depreciation loss year one? And are there certain properties that are more beneficial than others?
Certainly. Yeah. I mean, similar to multifamily, we're doing cost seg studies on most of our properties on, your typical QSR fast food that we've done a lot of on. It's been right around that 40% or so of the entire purchase price is what your bonus depreciation will be right now. Funny that you bring up the other thing. I'm actually looking at some car washes, convenience stores, and auto repair centers right now, which qualify for 80% bonus depreciation through the end of 2023. And that's really a huge advantage right now to offset, other gains or just take advantage of just depreciation in general. So those, again, you have to talk to a cost seg study specialist, but they're going to probably be double what a lot of the QSR stuff is right now. So again, I'm not an accountant, I'm not a cost seg study specialist, but the bonus depreciation and the tax advantages are extremely attractive right now.
Now that's definitely very attractive. And when you say 40% of the purchase price, you have to consider, if you do put leverage on the deal, so say you buy something for 10 million, you put a $5 million loan on it, you have $5 million of equity in the deal. Well, if you have 40% depreciation, that's about a 80% depreciation loss on your dollars invested in the deal. So, that sounds fantastic, even on the QSRs, but the other avenues that you said provide even around twice as much of that. So that's fantastic.
You hit the nail on the head. That's what we're doing on most of our stuff, is typically putting 40% down, leveraging 60%. So you're really getting that nearly 100% bonus depreciation, which is just a massive tool to have your equity, your capital working for you and not paying it to the government.
It is. And it's, we have the sunset clause right now. So next year it's going to go down to 60% bonus depreciation, and then 40, and then 20, and then 0, as long as they don't change anything. So it's pretty nice to take advantage of that bonus depreciation this year while it's still here and while it's so high.
Yeah, absolutely. Next year's going to be good yet too, but yeah, it's really timeliness. Time is of the essence right now.
Before we jump off here, how can someone get a hold of you if they wanted to reach out to you?
Email would be easiest, Kyle@granitetowersequitygroup.com. That's certainly going to be the easiest.
All right. Well, thanks so much, Kyle. I appreciate you.
You bet. Thank you so much, Mike. Take care.
You too.
Thanks.